bit earlier this morning. I spoke to Chris Hart. He was off somewhere and came into the studio early. He's the chief strategist at Investment Solutions, and we talked about the current account deficit and several other big picture economic issues.
The country has a deficit with the rest of the world. The government has a deficit with the country, and the households are also in deficit. And we've got to remember that the households are in deficit because that's the tax base. And that's why the budget was so counterproductive, is basically you're trying to extract more out of a base that is already in deficit. And so it wasn't a solution. It's creating additional vulnerability at household level, because households, then resources are even more stretched. And of course we're still vulnerable at national level, you know, with the government's finances that are in tatters, and then the current account deficit. If we take the cumulative current account deficit since the mid 2000s, we're now talking about a cumulative deficit of in excess of 1.7 times GDP. All right, and that has to be covered. So whether you cover it in debt or whether you cover it in investment, which then has to be serviced, it doesn't matter. But the current account deficit, 5.1%, less than expected, but still we get the dividend payments this quarter. It'll be then, that'll come back.
Well, let's look also at the micro level, the petrol price. That obviously has an effect. There's taxes coming into that. There's a currency effect coming into that. Something like R2 is going to be added to that litre petrol price.
So we were close to 10 Rand a litre at the end of January. We're now back to virtually 13 Rand by the time we get to the start of April. And that's going to undo a lot of the CPI effect. We're going to get a CPI number, and that CPI number I think will look quite good. I think it could be as low as 3.5 even. You know, it depends on the base effects and all whole heap of things, but it's going to be a low number, right at the bottom of the target. But unfortunately the core number is still pretty much close to the top of the range.
Just to cheer us up further, we've got wage negotiation time coming up, and the minister, as did the minister before him, Pravin Gordhan, and Nhlanhla is saying that's what we're wanting for the public sector wage increase, 6.6%, I think the number was. I doubt it's going to come in at that. We're going to end up with 9%, which will look good against the original claim. But let's just have a look at the strikes, the statistics of the strikes, and we're going to put that up on the screen there now. Workdays lost to strike action going from 1994, and they're the three spike years, 2007, 2010, 2014, where there was a public service strike.
It's just because of the number of people in the public service. Public servants cost the country roughly about 10% of GDP. It's about double of what our peers are, which was close to 5% of GDP. It's already way over the top, and it's been creeping up. I don't think they can turn that around very easily. And it's also transferring resources from higher multiply activity to lower multiply activity. It's one of the reasons why growth is constrained, but it's also one of the reasons why we've got such high taxes. It's one of the reasons why we're striking, is because households are under pressure, because people are not making ends meet, and so the unions are under pressure, and people are more likely to go on strike. And of course, how the money comes into existence to pay civil servants' salary is of course unknown in the civil servants. That just comes from Minister Neni. It's just magically arrives, and the appreciation of how difficult it is actually to earn that money is not, I don't think, is fully appreciated.
Let's look at numbers coming out today. CPI and retail sales expected. What are you expecting? You mentioned CPI expected to be on the low side.
CPI I think will be on the low side, but retail sales I think will also be on the low side. You see a lot of our consumption previously has been because we've been borrowing money going shopping, and those chickens are coming home to roost. Effectively, last year's economic growth and last year's retail sales were borrowed from this year. Now we've got to this year, and the capacity to borrow and go shopping is of course reduced, and that's starting to come through. It's a problem across the world. It's not just here where consumption debt has been trying to bolster growth. It's how policy is trying to get us to behave, to go and borrow money to spend, because it's the demand pull model of economics, and that is being exhausted and discredited very quickly.
all of this doesn't sound like we're going to have a good growth number. It's certainly not going to be 2% as the Minister has been projecting, or do you disagree?
No, the growth number is a difficult one because we had such a poor quarter last year at the beginning. So automatically just us being at work for the first quarter means that there's going to be quite a big jump, I think, from the first quarter last year to the first quarter that year, and that helps set the base for the year. So I think 2% is attainable. All right, and if the oil price drops as it is, and this is the last big increase we
still
start
in the
to
low
see,
50s.
Yeah, we could still come to a point where the oil price could still provide a big enough tailwind, and if Eskom just keeps their plants running, and that's a less of a headwind, you could still get an upside surprise to growth. But the global economy, the markets are rolling into a risk-off type of mode, and that can constrain growth.
That was Chris Hart, Chief Strategist at Investment Solutions.